Arbitrage funds present a distinctive investment strategy within hybrid mutual funds aiming to profit from price differences between markets, particularly the cash, that is the spot market and the futures market. But how exactly do these funds operate and what makes them attractive to investors? In this video, let us explore the world of arbitrage funds. Welcome to holisticinvestment.in. First, what are arbitrage funds? Consider this scenario. You purchase a stock on one exchange for rupees 100 and simultaneously sell it on another for rupees 102. That quick profit of rupees 2 is what we refer to as arbitrage. Arbitrage funds are designed to take advantage of such price discrepancies, making them an appealing choice for those looking for potentially stable returns. While arbitrage funds involve stock trading, they are classified as hybrid funds. Why? Because they not only invest in equities but also allocate capital to debt instruments for short-term needs. This combination allows them to maintain a lower risk profile, which is especially attractive to investors seeking stability compared to the volatility typical of traditional equity funds. Next, how do arbitrage mutual funds work? Arbitrage mutual funds function by taking advantage of price discrepancies between the cash and derivative markets, creating income opportunities from these differences. But how do they actually operate? Why are they considered low risk investments? Here is a straightforward example. Imagine shares of XYZ Limited are trading at rupees 100 in spot market and at rupees 105 in the futures market for 1 month contract. An arbitrage fund manager would purchase the shares at rupees 100 in the spot market while simultaneously selling them at rupees 105 in the futures market. This strategy locks in a secure profit of rupees 5 per share regardless of the market's direction. By buying low in one market and selling high in another, the fund can secure a risk-free profit. This process isn't a one-off occurrence. Arbitrage mutual funds continuously seek out such opportunities across various securities and derivatives, allowing them to generate consistent returns over time. Arbitrage funds are often seen as low-risk investments because they focus on exploiting price discrepancies rather than speculating on market trends. This approach results in less volatility in the returns generated by these funds compared to traditional equity funds. Next, features of arbitrage funds. Arbitrage funds are a hybrid investment that combines the growth potential of equities with a low-risk strategy. Think of them as the ninjas of the stock market. They skillfully take advantage of price differences between similar securities, like finding a stock at a discount on one exchange and selling it at higher price on another. Buy low, sell high and capture the profit. But it is not just about quick wins. Arbitrage funds are hedged for safety. By using hedging strategies, they minimize risk, offering more stability compared to pure equity funds. This means you can enjoy growth potential without extreme market fluctuations. And what happens when market turns volatile? That's where arbitrage funds often excel. During times of market turbulence, they can deliver better returns than non-equity funds, providing a safe haven for your investments. Next, benefits of investing in arbitrage mutual funds. It is a good idea to invest in arbitrage funds. What are its benefits? Firstly, they tend to carry lower risk compared to a traditional equity fund. How arbitrage funds focus on capturing price discrepancies between securities, making them less sensitive to broad market movements and reducing volatility. By capitalizing on short-term price inefficiencies, these funds aim to minimize risk, making them appealing to more cautious investors. Then there is a potential for consistent return. Even during volatile market conditions, arbitrage funds can profit from price differences, providing steady returns. This reliability is particularly attractive to those looking for a stable income stream without the fluctuations typical of pure equity investments. Lastly, arbitrage funds offer tax benefits. Similar to equity funds, they enjoy favorable tax treatment. Long-term capital gains above rupees 1.25 lakhs are taxed at just 12.5%, while short-term capital gains are taxed at 20%. This makes arbitrage funds a tax-efficient choice for long-term wealth accumulation. Next, we are moving into the returns part. First, comparable to short-term debt instruments. Arbitrage funds typically offer returns comparable to short-term debt instruments like fixed deposits or liquid funds. However, what sets them apart is their potential to outperform these options thanks to the tax advantages associated with equity investments. This makes arbitrage funds an attractive option for investors seeking a balance balance between risk and reward. Next, unpredictable payoffs. It is important to recognize that arbitrage funds return can be unpredictable. These funds depend on market inefficiencies to generate profits, but such opportunities aren't always present. As a result, while our arbitrage funds can deliver steady returns, the actual payoffs may fluctuate depending on market conditions. Next, risk in arbitrage funds. High expense ratio. One notable risk with arbitrage funds is their relatively high expense ratio compared to other debt funds. Why? These funds require active management to identify and exploit arbitrage opportunities, which increases cost. While arbitrage funds offer low risk potential, it is important to consider whether these higher expenses might reduce your overall returns. Next, limited profit potential. Arbitrage funds also come with a capped profit potential. The margins from arbitrage opportunities are often small, which limits the overall returns potential compared to more aggressive equity focused investments. If you are aiming for high returns, arbitrage funds may not be the best choice for your portfolio. Next, who should consider arbitrage mutual funds? Low risk investors and portfolio diversifiers. First, low risk investors. Arbitrage mutual funds are good fit for investors seeking low risk options. They are ideal for those with a short to medium term investment horizon, offering a balance between safety and consistent returns. Next, portfolio diversifiers. For those aiming to diversify their portfolio, arbitrage funds can be a smart addition. They provide exposure to equity markets with a lower risk profile, helping to balance out more volatile investment. Next, factors to be considered before investing in arbitrage funds. First, expense ratio. Before investing in arbitrage funds, always review the expense ratio. A lower expense ratio means more of your money is being invested rather than spent on fund management fees. Next, returns. It is important to compare the returns of different arbitrage mutual funds. Not all funds perform equally, so identifying those with a track record of solid returns can help you make a more informed decision. Next, taxation. In India, arbitrage mutual funds are taxed as equity mutual funds. For investments held for less than a year, short-term capital gains are taxed at 20%. If held over a year, returns up to Rs 1.25 lakhs are tax-free, while gains beyond that amount are taxed at 12.5% under the long-term capital gains tax without indexation benefit. Next, are arbitrage funds better than fixed deposits? Arbitrage funds and fixed deposits serve different financial purposes. Arbitrage funds may offer better post-tax returns and greater liquidity, especially for investors in higher tax brackets. On the other hand, fixed deposits provide guaranteed returns and a higher level of safety. So the best choice depends on your priorities, whether you value the potential for higher returns and flexibility or prefer the security and guaranteed returns that FDs offer. Conclusion. Here is a summary of all the points. Arbitrage mutual funds present a unique investment opportunities for those looking to balance returns with risk management. By leveraging price difference in financial markets, these funds aim to generate steady returns. However, it is important to remember that all mutual fund investments are subject to market risk. Before investing in arbitrage funds, consider factors such as your investment horizon, market conditions, tax implications, expense ratios, and the expertise of the fund manager. A detailed blog post on this topic is available on our website, and the link is given in the description.
And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.